Shout out Bucky's, America's gas station. Welcome back. So today we are going to be going over our stop loss and risk management. This is going to keep you profitable. I said it. This is the ticket to success right here. Like I have stated in my lessons up to this point, a nice healthy stop loss while swing trading is essential to profitability. So I started to find a lot of progress. I was able to scale my account due to correct stop loss placement. So that's what we're going to go over today. So, as you know, we do swing trade. So we are holding a position from anywhere from a day, 2 days, 3 days, 4 days, even a week, 2 weeks at sometimes. It all depends on how long the trade takes to hit our take profit, or to hit our stop loss, or to hit our break even if we have decided to put our stops and break even. So when we are swing trading, we are looking for daily and weekly stop losses. So as you can see, I am here in the daily time frame, and let's go back in time a little bit. So we'll start new. Go right here. I'm going to make myself a little area of interest. I'm going to note that down first. Let's note that down. When swing trading, we need swing trading stop loss. So daily or weekly stop loss. I typically go with a weekly stop loss. So I'll look at the weekly areas of interest and see if the trade is ready to play out that week. If it looks like it's ready to play out, then I will look for my entry signals and take the trade. But the market has to do what the market has to do. For example, if price broke below here, more than likely, let's say price breaks below here and we are wanting to sell. Let's say we're wanting to sell right here for some reason. It's not the best example, just a quick example. And let's just say we're shorting the market, right? So right here, we have our stop loss above the previous weekly structure point. I'll put it above this little wick right here. So we got the weekly here and it broke, right? So more than likely, the next weekly is going to be the pullback, which is this candle right here. So we wait a week for the pullback. And then the next week, we can anticipate the move, right? As you can see, we had a move here. We actually got a little, actually rejected, and then we got this big push to the downside here. So we call this right out of longitude. You have to wait for the market, You have to anticipate what it's going to do and what it can do and what it realistically can do. So I'm going to put that down as well. Wait for the market to do what it has to do. The market needs to break and retest. So that's what we're going to wait for, right? Here on the weekly, on swing trading, and I want to set a weekly goal. Then, which would be this move right here, not all this. Right here, we had that break. Next week, we had the retest, and then we started having the move. Then we ended up holding it for 2 weeks and had the entire move to the downside right here. Closed off, kind of wick right into the take profit, and came back up. So let the trade do what it needs to do, and don't expect everything to happen in 1 week. The break, the retest, and then the buy or the sell. Wait for what it needs to do. If we get a break, great. Wait for the next week. We get the retest, great. Then wait for your entry signal. And then on the third week, typically you can have the move. When swing trading, I like putting giving myself a daily stop loss and a daily take profit. For example, if we were right here, let me mark my little area of interest. Right here. Get my rejection. See how it plays out. Boom, perfect. Over here, I have my short position, right? Just I could either target this low or I could target these lows down here. It's up to you. The lower the daily low is, the longer you're going to hold your position, which that's fine by me. I'm okay with being in a trade for 3, 4, 5 days, even a week, even 2 weeks, if need be. Some markets move faster than others, but one like Euro USD moves pretty fast. So we would have waited for this break, then we get our retest, then we wait one. We could have entered on the retest, get our entry signal, and price just consolidated for 3 days, and then had the move, had another little pullback, and then had the entire move to the downside, which we would call our 1 to 2. As you can see, the previous structure point, my stop loss is above. I even like to put it above that wick, honestly. And then, yes, target those lows down here. Which gives us almost a 1 to 2. Might even pull that down almost a little bit because that is very high. Previous structure point's really right here. But just to be on the safe side, let's open up 2 just like that. Okay, so this is a very spacious, it's a good, healthy stop loss. These are the lows that we would be trying to catch right down here. You can even put like a little area of interest down here just to kind of show you where you want to target. Put stop loss above or below highs and lows. And even the wicks from those structure points. So in other trading rules, we are always going to make sure that we have a minimum of a 1, 2 risk to reward. We're going to make sure that we are always trying to double what we have put into the markets. Minimum of a 1 to 2 risk to reward. I would say a core rule is the percentage you risk. So I'm going to tell you guys what's healthy risk, and that's anywhere from 1 to 2% of your account. Have I always done a 1 to 2% risk of my account? No. I don't think I've ever risked 1% of my account. I mean, that's having a $5,000 account and only risking $50. Like, come on. I mean, I get it when you're taking a bunch of trades and you're scalping the market. I get it. 1 to 2, you know, But when you have high quality and high probability setups like we do as swing traders, the 1 to 2% is going to take us forever. Because see, these scalpers are taking multiple trades a day. We're taking a maximum of 2 trades a week, maybe. I typically just try and get one good solid 1 to 2 risk to reward. You know, if I risk $5,000, $10,000, I'm wanting to make $10,000, $20,000, you know, in one trade. You know, so I'm going to be risking a little bit more than 1 to 2%. I've always done that. I mean, even since the beginning. If you want my personal opinion and you want to scale your account faster, do anywhere from 5%, do 5 to 6%, maybe 7%. I've always done 5 to 10%, depending on the trade. If you're doing an account flip, then you want to risk, you know, 25, 50% every week. But on your consistent account, you know, consistently trading, I did 5 to 10%. 1 to 2%, just a little too low for me. But trade at your own risk, trade what you feel comfortable with. I'll tell you guys what I've always done. So now kind of jumping into how to calculate your risk. Right now, my stop loss is 87.8 pips, right? And then my take profit is 175.6 pips. Now, pip is a market measurement, right? So, how do we calculate this? How do I know that I'm risking 5,000 right here and not $2? What you want to do is you want to go onto myfxbook.com. This is going to give you a lot size calculator. A lot size calculator. So you're going to want to go over to myfxbook.com. It's 100% free. This is your position size calculator. You're going to type in your currency pair. I am on Euro USD, your account currency. Mine's a US dollar. Account size, let's just put $10,000. Your risk ratio, so you can either get the percentage of it, so let's just say 10%, and then my lot size or my stop loss is 87.8 pips. So we're going to put 87.8 pips and then calculate. And right there, it will show you if I'm risking 10% of my account, I need to put into my MetaTrader 5 or whatever platform you're using to enter your trades 1.14 lots. So that is your lot size or your trade size. So you can also say I'm doing an account flip. Let's say I'm wanting to risk 50%. Well, you can either do 50% or just swap with money and put 5,000. Boom, calculate. Now my trade size is 5.69 lots. So does that kind of make sense? This is super helpful. I've used this for years. This tells you that, okay, now this is going to mean $5,000. So if you were to get taken out, you would lose 5,000. But you have a 1 to 2 risk to reward. So if you predicted the market correctly, you're going to make $10,000. Does that make sense? So myfxbook.com, that's where I do all of my, that's where you find your trade size. Find trade size here. Now I'm going to show you guys a bad stop loss placement. So let's say, okay, I'm doing everything right. I wait for the break, wait for the retest. I get in the trade, get my entry signal right around here. Okay. So let's say I get my break, I get the retest. Let's say I get my entry signal somewhere around here. We're going into a little bit of drawdown, which is fine. Let me say that I put my stops right here or something like that. A very tight stop loss. It looks good. Look at that, 1 to 3. Wouldn't that be nice to hit? That's great. And we can even hit a 1 to 3. I've hit plenty of 1 to 3 risk to rewards while having a big, nice stop loss. But right here, we have a very tight stop loss, 56.5 pips. We have a tight stop loss. This right here, price would have taken us out. Even though we were correct about the direction of the trade, price would have taken us out because it barely wicked in right here and took us out. And this could have been easily avoided if we had just raised our stops above the previous structure point. So right here, wouldn't that suck right there to lose $5,000 by that little wick right there, and then have all of this go right in your direction where you could have made $10,000? That is the worst feeling ever. I've experienced this many times. So let me go ahead and tell you guys, put your stops above your previous high or your previous low, depending on if you're buying or selling. But let me be the first to tell you guys, just so that you guys don't have to learn the hard way. So I'm going to go ahead and say, don't put stops too tight. Leave plenty of room for the market to breathe. I'm also going to put right here, always aim for a minimum of a 1 to 2 risk to reward, or 1 to 3. 1 to 3 is definitely not impossible at all. Now, sometimes I won't even use a take profit. I will just let my trade go. Sometimes there are some catastrophic news events, and I will, and the news will go in my direction, and I will hit a 1 to 4, 1 to 5 even sometimes, and while having a big stop loss. Now, also, news can take you out like that, but it can also go in your direction. But if you're up a 1 to 1 already and you see news coming up, I typically put my stops at break even. So I'm either breaking even and getting out of zero, or I'm catching a 1 to 3, 1 to 4, potentially a 1 to 5, just depending on how heavy and volatile the news is. I encourage you guys to focus on taking at least just one trade a week. If you see everything present itself, taking a minimum of one trade per week, maximum 2 with swing trading. Well, let's say that you get in and out of one. Let's say you made 10% of your account. Let's say you're risking 5% on the next trade and you lose that. You're still profitable over the week and you've made 5% on your account. So a 1 to 2 always keeps you profitable and gives you room to lose. You don't want to lose, but it gives you room to lose so you're not blowing your entire account. So a 1 to 2, aiming for a 1 to 2, risk to reward keeps you profitable. Now I'm going to tell you guys what I typically do. If I'm in profit quite a bit, I'll keep my trade open over the weekend if I haven't hit my take profit yet. But a lot of times I'll close the position even if I am in profit. It all depends on the trade. But what you guys need to be aware of are market open gaps. So market, when and if holding a position over the weekend when the market is closed. Sometimes when the market opens back up, it will have huge gaps. And of course, it'll have high spread at that time. High spread. Now that's all the time, high spread during, right after market open. High spread. Where the spread, you see how up here it's 2.9? Well, when market closes, when market opens back up, this thing's going to be at like 50. Sometimes 50, sometimes 25, sometimes 40. It's just a huge, huge spread, which the spread a lot of times can take you out very easily. Along with the gaps, it's very dangerous to hold over the weekend. And I particularly don't like doing it. I've done it before and I've been wrecked, but I've done it before and been fine. If you want to be on the safe side and the cautious side and the conservative side, just close before the weekend. Do you move your stop loss to break even? And when? Moving stop loss break even. Wait for my trade to be at a minimum of a 1-to-1 risk to reward. Because that's then shown me that, okay, we have a lot of strength going towards my direction. If price does turn around and start shifting structure in the 30-minute and the 1 hour, even the 15-minute, price is probably going to come back and, yes, take me out at break even, but more than likely going to come back and price is turning around. I typically put my stops at break even at a 1-to-1 risk to reward. And you guys, that has saved me so much money. Yes, you're trying to make money in the markets, but protecting your capital is so important. That is number one. Before making any money, if you can protect your capital so that you can keep making money, that's what you need to do. So putting your stop at a break even when you're at a minimum of a 1-to-1, great, because typically what you'll see in the markets, you'll see a domino effect. If it shifts structure in the 15-minute, it's going to shift structure in the 30-minute. If it shifts structure in the 30 minutes, it's going to shift structure in the 1 hour, then the 2 hour, the 4 hour. I'm very big on protecting your capital. Protect your capital. Let me tell you, this right here, protecting your capital, protecting my capital, made me, along with risk management, having appropriate stop losses, made me profitable. These two things right here, stop loss placement, correct stop loss placement, and then moving your stop to break even at a minimum of a 1-to-1 risk to reward has saved me so much money and has made me the profitable trader that I am today. So if there's anything that you learn from this lesson, incorporate these two things into your trading and you will see a massive difference. So how does all of this risk management, stop loss placement, everything, risk to reward, all of these rules right here keep you profitable over the long term? Well, say for one, it prevents account destruction. 2, it lets your winners always outperform your losers. 3 you confidence in your trading way emotion. That's one thing. It's not letting your emotions take over. Let the trade play through, but always be aware of what the trade is doing. Check your phone every once in a while. Okay, what's the trade looking like? Okay, it's looking good. All right, we're in profit now. Great. Oop, we're in drawdown now. Let's not panic. We don't panic at drawdown. Price needs to move. Just let price do its thing. Get into profit. Get to a 1-to-1. Put your stops at break even. Once you put your stops to break even, you will, any panic mode you had before is gone. Like it totally eliminates the stress of risking, especially when you're account flipping. This is so important when you're account flipping, and you're risking 50 to 75% of your account. Putting that 1-to-1, putting your stop at break even is so important. Number 4, it enables you to compound your account and take way less losses than the rest of the traders in the world. So, risk management is the difference between a blown account and a growing account. Without risk management, without calculating how much you're actually risking, because we don't want to be gambling. That's one thing that you do not want to catch yourself doing, is just putting money into the market and seeing if it goes up or down. You're wasting your time, you're wasting your money, and you want this to take over your 9 to 5. You're wanting this to be your main source of income, and it very, very well can be. But it takes commitment and it takes risk management. And it takes keeping yourself disciplined and protecting your capital. Another thing I want to put here is put your stops above wicks as well. Just like over here, we put our stops above our wick. Make sure that we're getting a 1-to-2 risk to reward. And put us down here. Okay, so does this make sense? So you've learned stop loss, correct stop loss placement, moving your stops to break even, what risk management prevents, and wait for the market to do what the market needs to do. So I hope that all of this was understandable. Definitely make sure to go to myfxbook.com and you can use their free lot size calculator. And that's basically it for putting your stop losses in the correct places. Giving yourself a 1-to-2 risk to reward, risking 1-to-2%, up to 5-to-10%. And if you are account flipping, we will talk about that later. But yes, 50-75% on account flipping. Yeah, it's kind of insane. But yeah, so go ahead, screenshot this, and I will see you guys in the next lesson.